Hey, and welcome back to Money for Life. My name is Kaylee Roberge, and I'm your usual co-host, but today we are inviting you in on another conversation that Eric's had with an expert in a particular industry. This one is really, really cool because we're exploring the world of startups and venture capital, which is a different kind of investing than we usually talk about on the podcast. So I'm excited to dig into this to give you a little bit of a different angle and a different conversation on portfolios and risk, what it takes to run a fund, what it takes to deal with the startup world and angel investing. So really exciting stuff, something a little bit different than what we usually cover. And our guest today is Jess Lynch. Jess is a co-founder of Founders Edge, which is dedicated to helping founders succeed by leveraging her own entrepreneurial journey. She's the former CEO and founder of WishRoute, a company that got acquired in 2023, and she specialized in improving user experiences. With a background in financial forensics at PwC and dual valedictorian honors from her MBA and MSA from Babson, she brings deep expertise in finance, valuations, and strategy to the founders that her fund consults with and works with. Jess has angel invested and consulted with startups across industries, guiding founders on customer discovery, use engagement, fundraising, and M&A, with a reputation for turning challenges into actionable plans. And today, with Eric, they are going to cover a range of really cool stuff, including Jess's background and how she went from PwC to the startup world and now to angel investing and running her own fund. She shares a little bit about what her day is like as a fund manager. What does that take day to day? And then as an insider, how does she look at where venture capital and private equity placements play into a broader investment strategy and what investment risk looks like in her world? We talk a lot about that for us and personal financial planning, but Jess has a little bit of a different take and there's some overlap too. So stay tuned. I'll let you jump into this conversation. No more yapping from me. I will let Eric and Jess take it from here.
Hey, Jess, welcome to the show.
Hey, excited for our conversation.
Yeah, I'm really excited about this because it's one of those areas that angel investing, private investing in general, I guess, outside of the stock market is something that comes up often in conversations that we have with our clients because, people think that there's another way, right? Another way to create what they need to grow their wealth. And a lot of times the private sector comes up as the way to do that because not everybody can get into it and it seems mysterious. So I want to take the veil off and just really get into like what it's all about, what you do on a daily basis and how it all works and how people should think about investments in this kind of thing.
Absolutely. And it's what we see in the news and it's the companies we all talk about. So it's an exciting place to play, but it's also a really easy place to lose money.
I'm glad you said that because I always say that too. And I don't know if people believe me because I'm supposed to be the conservative one. So let's start off by just getting into a little bit of your background and just how you got from, Babson College, right? We both went to Babson College. How you got from Babson College to angel investing.
So I've always been entrepreneurial. Both my parents were entrepreneurs and my grandparents, did things out on their own. So it was in my blood to some extent, but I took a pretty conservative path right out of school. I did financial forensics at PwC, doing fraud investigation, valuations, and that's actually lended itself very useful as an investor, being able to do financial modeling and understand unit economics. What's the chance a company's going to succeed if I invest at X valuation? What does that mean over the long term? But it's still a big corporation and I learned a ton and I'm so, grateful for that experience, but wanted to go out on my own and build a company myself. And so I actually went back to Babson for my MBA and that's when I started my startup, WishRoute. And I think it's easier to get into private investing when you've started a private company that received private investment because you are just all of a sudden in that world and getting to know people who make that decision to angel invest or to start a venture capital fund and invest. And my company did text message marketing when that started to become a channel businesses could text consumers through. So we hit the market at a great time and it was a wild ride. Starting a company from nothing is definitely the worst and the best thing I've ever done, but equally both very stressful. learned a lot. And one of the things that struck me through that journey was how impactful those early angel investors were. Angel investors play a really critical role in our innovation economy. They're the ones that get an entrepreneur their first few $100,000. And if you don't have wealthy family, you have to go to angel investors outside of your immediate circle, and they decide which ideas really get off the ground and get far enough where then venture capital investors and other private market investors get interested. And so when I sold the company, I was thinking about what I wanted to do next. And that was immediately front of mind if I wanted to give that yes to entrepreneurs I believed in, just like people did for me.
Yeah. There's so many things in there that I want to talk about. Firstly, the fact that you had experiences in the past and you didn't necessarily know what those experiences were going to do for your future and how they were going to benefit or not your career. And I can totally relate to that too, as far as my background. But for you, the forensics and then the startup and then saying, wow, now angel. So I can see things, you can see things from a different perspective than a lot of even just angel investors that jump right into it because you've been there and done that, which is, I think, super valuable.
And everyone brings some experience, to the table. Like angel investing just means that you're betting on business ideas and people that are going to work. And so if you have really deep expertise in a certain industry, like if you're a doctor, you might see opportunities in your practice for innovation, and then we'll be able to make a really good bet on founders innovating in a space better than maybe even the founder does, or hopefully not. But I think everyone brings some expertise that actually can give them an edge as long as they lean into that and don't just throw money in anything.
Yeah, that's true. And two, obviously, if you are an angel investor, I'm sure that you're helping coach or at least provide insights and support as an advisory board or something similar to the founders so they don't have to know everything about everything and they can tap into that expertise that is around them, correct?
Yeah, I look for confidence with coachability. I'm not looking to build a business for someone else. I want to invest in people that feel smarter than me, but they don't need to be smarter than me at everything. And they need to be open to tapping their mentors and advisors when they know that someone else might, really add value and be able to help them think through something better than they could alone. But there's a lot of benefits to angel investing outside of the financial return. Part of it is that feeling of fulfillment that you're helping someone else. We all like to help, especially when we have hard-won lessons or networks that can be really valuable. And by stepping into this kind of sphere, it's a huge network of people up to really awesome, exciting things that can open a lot of doors for you personally outside of that investment. And you learn a lot by watching companies fail and succeed and kind of interacting in this innovation economy. It adds a lot, especially if you're in a more corporate stable environment that doesn't change that much. It can really help you see into the future in a different way than your colleagues can.
Sure. I think it's really interesting to think outside of the return, right? Because I know that working with clients who it's all about like living well and growing wealth. Mm-hmm. And there's the giving back and there's a lot of other ancillary things that are super important to some people. But I think when you talk about angel investing in the general public, I don't think the first thing that people think of is like, you can actually help others succeed. And you brought that up as one of the main drivers of why you do this. So can you just talk a little bit more about that for you?
Yeah, well, and it's really a societal layer. Like I said before, angel investing is that first vote of what ideas and founders get off the ground. And that initial capital and the momentum the founder builds is then supported by other private market vehicles like venture capital or private equity and customers paying. And we have a lot of inequity on what kind of companies and founders get funding. And so by being part of that vote, you really are changing what products come to market and what your world looks like, what shows up in the stores. But, less than 2% of capital goes to women-led teams. And it's a pretty staggering number. About 30% of venture capital goes to a mixed gender team, but about 70% is going to all male teams. And, it's just something that is a symptom of a bunch of things, but one is just who's making the investment decisions. Men are controlling the vast majority of capital allocation, and, the founders that get backed reflect that. We feel more comfortable with what we know. And when people look like us or feel like us, it builds confidence and trust. But it also leads to inequity.
Sure. I mean, that makes sense. And so that you had initially said that you look for coachability and expertise, I think you said, with founders, but are there other maybe demographic type of factors that play into you really wanting to help somebody else?
Yeah, definitely. After angel investing for a little while, I ended up teaming up with one of my prior investors in my company to start a venture capital fund. And, the difference being angel investing, you're investing your own capital, venture capital, you're raising money from other parties, individuals, institutions, family offices, and you're investing money on their behalf. You also put some of your own money in, have skin in the game. And we did about 2 years of research before starting the fund, Founders Edge, about what leads to more founder success. And we found it very correlated with experience. So having decades of experience in an industry, having startup experience, because taking a company from zero to something is a very different skill set than working at a big corporation and doing your day-to-day job. And also having a deep technical background. Founders, CEOs, you might think that MBAs are more predictive of success, but actually in our research, we did a big study on LinkedIn profile data, has led us to realize you're actually about 2.5 times more likely to be successful if you have a computer science background or some sort of technical background if you're starting a tech company, which I guess makes sense, but wasn't necessarily, I would have bet on the MBA for a CEO role. So we look at very technical founders, experienced in their industry. They can call their first 10 customers instead of cold calling and have startup experience before.
Sure. I do think that makes sense because oftentimes people, if I'm talking in our industry to a financial professional, someone that has a finance background, but it's more corporate finance versus personal finance. And then the outside world says, well, of course they can manage their own money. Not really. It's not necessarily the same thing. It's very different, even though it's the same big picture category of finance. There's many facets.
I don't do my own taxes. It's special expertise.
Yeah, that's true. Okay, so before you've identified the founders, like what are you doing on a daily, weekly, monthly, whatever period of time basis to the first layer being just identify people? How are you finding the companies, number one?
Yeah, so it's different as an angel and as a venture capitalist. As an angel investor, when I was getting started, I was in founder communities. So my first investments were some of my founder friends that I really believed in and had seen execute over the previous few years. And I was so honored to write them a check. And then I joined TBD Angels, which is an angel group in Boston, started by two of my prior angel investors, actually. And I think angel groups are a really great way to get started because you can learn a lot and it's not all on you to do the due diligence. It also can bring the minimum check size to kind of play down. So like at TBD Angels, the minimum check size to make an investment is $2,500.
Oh, wow.
Versus when you're investing directly, founders often won't take a check less than $25,000 or $10,000. And so, it makes them more accessible and also helps with getting deal flow. As a venture capitalist, we've developed kind of 4 channels for our deal flow. One is we're very active online, posting a lot of thought leadership that's helpful to founders on LinkedIn and TikTok. I actually just had one of my TikToks get 30,000 views from my founder community. So that leads to deal flow. The second is we do a lot of in-person events, bringing people together, helping get our brand out there. The third is we have large networks. So the people that have invested in the fund send us deal flow. Again, we've been in these founder communities. We've had prior colleagues. So we have hundreds of people that refer deals to us, other co-investors. And then the fourth is actually proactive. So we have some tooling that helps us search for founders on LinkedIn that meet certain criteria. And then we reach out to them. I've had 2 calls yesterday from this in the auto tech sphere that looked interesting and I wanted to meet and they were willing to take a call with me. So we jumped on.
Oh, nice. Okay. So then when you find the founders that you really want to believe in, and you have to do the due diligence on the specific company itself, like what are you doing and how do you go about that due diligence and just identifying things that are opportunities and also red flags that come about?
Yeah, I've developed a pretty rigorous due diligence process for the fund. Part of the research we did on founder traits led us to develop what we call a founder index. So we ask founders the same 60 questions. Most are yes, no. It doesn't take very long. that we consider. And so that leads to us having less bias. And we're asking, the same questions of every founder seeking funding, basically. And it also gives us some signal behind the scenes on their propensity to be able to drive, really high return. And then when we're doing our due diligence process, I did about 18 months of research on why founders fail and succeed and developed it based on that. And, if you're an angel, it falls into a few buckets. First is the company set up in a way to take outside funding? Are they a Delaware C Corp? Do they file taxes? Some of that kind of financial competency there. Do they have a startup attorney, someone who's really an expert in this type of fundraising and company? You don't want your kind of family attorney doing this type of work. So you want to know that they have the right guidance and consult around them. The second is on their customers and their traction. How have they validated, even if they don't have paying customers yet, really thinking about, do they have a clear customer persona? Do they have a specific, because unfortunately, founders tend to drown in opportunity versus not have enough. And if you build something for everyone, you're really building it for no one. And so, looking at who exactly are they selling to? How are they reaching them? Do they have any proof that they can do that? And that this problem exists and people will pay? You're kind of like assessing how thoughtful they've been on identifying a problem and solution and how they validated it. And then the third is on the founder themselves. Are they all in? What's motivating them to do this? What happens when capital's tight? How much runway do they have? How are they going to make decisions? So those are some of the lenses that I look at when I'm doing due diligence.
Which is super important. And I think, I see it all the time in personal finance when people are just kind of blind to the downsides or the things that are actually red flags because they just look at, well, but if it all works out right, this would be great. And I love the idea, right? It's almost like buying a house. The house looks great on the outside. This is such a great community. And then there's all the rest of the stuff that you have to really pay attention to because you're going to be living in it forever. In this case, you're going to be putting your money in, and that money is either going to go away completely or come back in some fashion, hopefully more than you put in.
Yeah. And I always really stress, if you're getting into angel investing or any kind of investing, diversification is super important. We're talking about the private equity, venture capital asset class, the private markets, and it's high risk, high reward. So we don't typically see people investing more than 4 to 7% of their net worth in this asset class. And if you are allocating to this asset class, it crosses stages. I invest at the really early stage. It's called pre-seed, pre-seed seed. So it's really getting companies to their first million in revenue. You can invest in later stage companies, growth stage, they call it, which is more at the series B, C, D, about to go public, where companies are more at the $100 million revenue mark. And you also need to make multiple bets. So my rule of thumb is if you're going to angel invest, to do at least 20. And so if you're allocating a percent of your kind of investment strategy, you have to divide it by 20 to figure out what your average check size is. And that might inform whether you need to go through angel groups that basically do special purpose vehicles that brings the check size down to 2,500, or if you can go direct and invest 25K in each company you're interested in. But there's some math involved in making sure you do it with some financial discipline.
Got it. Okay, so let's dig into that a little bit. So the 4 to 7% of net worth gives you the dollar amount that is available to invest in this asset class based on that rule system.
Assuming you have money saved for your kids' college, that you're covering your expenses, you have that safety net of savings. This is definitely the play type of investment, not the fundamental, I'm going to be okay and retire.
Right. Exactly. I'm glad you said that because that's my lane to be able to make sure hey, caveats here, but it is true, right? There's a certain segment and the segment has to be free and clear to be able to you should be able to lose it and not have your life be devastated by said money. Mm-hmm. And so, all right, the 4 to 7% is identified and say it's well, it's, I don't know, it's $100,000 just to keep it a round number. You're saying, well, it's not like you should just put that $100,000 in one company to do the 4 to 7%. It should talk more about that.
So then your average check size is about $5,000. And some founders at the early stages, which is the most risky, will take a $5,000 check from an angel investor. So That doesn't preclude you, but angel groups may be your better way because then you're syndicating with others and you're getting that founder 150K check. So you're kind of pooling resources. Another thing that comes up is follow-on investment. So if you have an investment doing well, or even not, the founders will probably come back to you and ask if you want to follow on. So if you are wanting to continue to support the founders you've invested in, you actually need to divide that 100K by 25 or 30 because you'll want to follow on for your top, 25% of investments. So that's what we did when we started angel investing. We divided our pool by 25 so that for the top 25% of the founders we invested in, we had a check ready to go to follow on.
Got it. Which makes sense, right? To continue to re-up where something is actually working, or you have a different stage and now it even is more believable and you've passed the hurdles that were initially a big question mark. And now it's like, well, those are gone now. We have other risks, but it looks better.
Yep. And just staying disciplined. It's just like budgeting for anything. You have a budget and you stick to that budget. This is not, Vegas. Or I'd recommend if you're going to Vegas, set a budget there too. Like you don't want to get caught up in the excitement. Like this is a financial investment. You set a budget for it and you should stick to that budget.
Yeah. And speaking of the emotional side, right, getting caught up in something, I think one of the most common things that we deal with clients is they come to us and say, hey, a friend, a family member, somebody is starting this business. We believe in them or we believe in the concept. We want to invest. And it's the only company in the category because they weren't looking for it. It came to them, but they want to participate, which goes against a lot of things. One, it may or may not be too much money based on the net worth. It also may not be the diversified bucket for angel investing because it's just one company. So I don't know. Do you see this a lot? Like, I don't even know. How would you think about this setup?
When I was fundraising for my first company, I had some family and friends invest in the company. And to me, as the founder that, wanted to be able to look across the table at Thanksgiving and feel comfortable, I made sure that they were basically investing money that if I needed the money, like for a car or for a down payment, those family and friends would have given me that money. It wasn't so much that they were counting on a return. And I'm fortunate to have some family and friends that could write a 25K check. If I had gone to them and say, hey, I'm in trouble, can you give me some money? Like they would have given me that money. So it wasn't so much that they were going to have a deficit by not getting it back. So that was an important hurdle for me as a founder because I wanted to feel comfortable taking the money, whether or not I was able to deliver a return. And for them, they wanted to support me and feel part of it and follow along. And so I think for a one-off like that from a family and friend, I would personally take the bar of if this person asked me for some money because they were in a hard spot, what would I just freely give them? And that's how I would look at it. Because there's a number for all of us, right? It might be $500, it might be $5,000, it might be $25,000, but there's some sort of like gift that you're willing to just give someone. And you don't have to look at it like an angel investment and now you're an angel investor, even though you are. The other way to look at it is, no, this is going to be the spark for me to dive into angel investing. And this will be my first angel investment, but I want to have a portfolio and I'm going to be thoughtful about how I go about this and kind of follow what we were just talking about.
Sure.
What about you? How do you think about that?
I personally haven't had that situation come up where someone's asking me to invest in their company that I know.
Yeah.
Maybe some random people and I don't know. And it's easy to say, no, I'm good right now. But I like the idea of what you said there of how much money would I give this person if they were in need? That is such a great framework to use because then it gets very clear. Like, all right, there's an emotional component and there's a limit, right? Like I wouldn't just throw it all at them because I believe in this concept. It's support for the person.
Yeah, there's nothing wrong with that.
Yeah. And you can build off of that for sure. So that's kind of when I talk to my clients, I say, listen, like this money, we have to look at it as it's gone essentially. Yeah. And hopefully it's not.
Right.
But it's gone. What does the plan look like otherwise? Are we still good?
Yeah.
Or what are the trade-offs here? Like maybe you can't also go on that blowout trip around the world for $40,000 this year because you just invested that $40,000 in this company instead. Is that okay for you? Yes. Good. Let's move forward. Like that's the kind of way that I would talk.
Yeah. Makes sense.
I mean, any exciting things going on in your company now, like the concepts that you've come across or like things that are working or just whatever you want to share about
Yeah.
excitement?
Well, we invest in as experienced founders, as I mentioned before, that are using AI to really transform how work gets done in their industry. So we really like vertical plays, we call it, where a founder has deep industry experience. We invested in an insurance technology company that helps them automate back-end operations around their legacy systems that are really archaic and hard to integrate with. And they've gone from almost zero revenue to almost $1 million. They'll be at the end of this quarter in less than a year. And that's a female founder that I just like believe in so much. We are seeing a lot of internal efficiencies with all the AI tooling these days. We use Claude Code to automate a lot of our admin tasks. We call it our chief of staff. So we have it hooked up to our CRM, our email, our calendar, a bunch of other systems, and are able to get work and analysis done so much more quickly. And so it's actually something we're now looking for the teams we invest in to be doing the same. We ask them, what tools are you using to make yourselves more efficient? We're asking the technical team of each company, are you using Claude Code to help augment code production? And it's really a huge red flag if they're not. So that's been interesting just over the last 2 years of how high that bar is. Like we want founders using every advantage to build their company, because if they're not, their competitors are, and they're behind.
Sure.
But it's amazing what you can get done these days.
Yeah, I bet. If you're looking at an AI company that's not using AI outside of like their concept that they're trying to, make work.
Yeah, outside the product.
Do you really believe in this area or not?
Right. Totally. And it's awesome that they can get so much more done with less capital, because it gives founders more optionality of how much money they raise. Raising money, you give up a lot of your company. And so to be able to own more of it and control more of your own destiny, it really makes it easier for someone to start a company. But that also brings in a lot more competition. So we're looking for defensibility in ways that we wouldn't have 5 years ago. The bar of is this defensible is that much higher because it's so easy to spin up software.
Sure. Obviously, from a people perspective too, I mean, there's a fortunate and unfortunate piece here where if companies are more efficient, they don't have to hire as many people, and therefore the people that they were going to hire are maybe not getting the jobs that they should have gotten. So there's the downside of things. But at the same time, if you're able to have a very narrow bench of employees, the cost of running the business drops significantly, which means you can reinvest further and suffer maybe, or deal with, not suffer through, but like deal with the downturns.
Yeah, definitely.
Along those lines, just like the overall investment risk concept, like I know we've talked about like diversification, but like how do you as an investor think about investment risk?
There's a lot of layers to that. Part of it is the initial strategy of where you're investing and how you'll diversify, and the ownership you're going to target, how much you're going to invest in how many companies. The second was that we took was what's our thesis? Like, look, what elements need to be true for us to get excited about a company. And so for us, really looking for founders that have a strong appreciation for user experience and making something really frictionless to add value to a customer. Our research has shown that leads to like about 2x the typical returns in public companies that prioritize user experience over ones that don't. So it's kind of like pointing your ship. And then it's a lot of due diligence. So like we use our founder index to help us screen our pipeline to highlight the founders most likely to succeed. And then when we get excited about a company, it's checking off all of those things that can be landmines. Is the company set up right? Or do they have the right contracts in place with employees? Do they have the right ownership? Sometimes there can be funky stuff with the cap table, and founders that are no longer involved in the company can actually own huge chunks of it, which can create lots of downstream issues. So really looking at the company, the team, the product, the customers, the market in our diligence process, and then throwing our full weight behind them. Once we invest, you also have a little bit of influence on if the company succeeds. Are you making the best introductions? Are you helping them with their product and marketing feedback? And so it all really comes together. But in general, pre-seed investing where I am, it is a high risk, high reward asset class. And so you have to go into it with that mindset, not that every investment's going to pay off. And that's why diversification comes back to being so important.
Sure. One of the questions that we like to ask here a lot is basically playing devil's advocate with yourself to say like, okay, I like this concept, but let's step aside and say, why should I not do this? What could go wrong? And really being objective about that, because it just gives you the ability to detach for a second and literally be objective and try to pitch the opposite of what you're trying to choose to just give you some breath for a second to say, is this still right for me? All right. So just a couple questions here before we wrap up. Biggest misconception about angel investing?
I think that you have to be super rich, because the floor is really like $2,500 an investment. You know, if you participate in these special purpose vehicles through angel groups or syndicates, your check size can be $2,500. And so when we go back to like having 20 investments over a few year time period, that's $50,000. And I'm not saying that's nothing, but that's probably a lot less than people assume. To be able to then be part of 20 different companies' journeys and be in those networks and those learnings and hopefully have at least your money come back through one of them. So I think it's more accessible than people think. That's
a great point. I do think that, I mean, even if you go to like LinkedIn, some people put angel investor on there just to spice up their profile. They're not truly angel investors. And they could say angel investor and be honest about it with $2,500.
Yeah.
Versus Shark Tank.
Yeah, right.
different concept. And that's the cool, sexy stuff that people think, I think, with angel investing, but it can be much more commonplace for a lot of people, which is exciting when you think about it that way.
Yep.
I know we've talked about this a little bit, but just if someone's interested in thinking about an angel investing, or like, I'm just kind of like looking through the window right now and seeing what's inside there, and I don't know what to do, and I'm scared to do it, but I am very interested and I would like to move forward and take that first step in. Yeah. Like what is the first step for someone to just wade into the angel investing pool?
Yeah, there's multiple ways. One is to look at the startup events going on in your city and just start showing up. You can bring a friend or bring your spouse, but you just start going to pitch events, and if you search for them, you'll find them. If you're in Boston or Connecticut or New York, you can send me a note and I'll tell you which ones are going on. There's some central calendars basically in this world, so you know where to go. And that just you'll naturally meet people and open up this world. Another is looking through like your LinkedIn network and seeing who's a founder, who's an angel investor or an investor, and like go have coffee with them and ask them, how can you dip your toes in? What do they recommend? Because in all likelihood, there's one or two people at least in your network that have taken this step in, and everyone's always willing to pull you up behind them. And then third is looking for local angel groups around you. And there's some national ones, like Hustle Fund has an angel group associated, Portfolio, Gangels. There's a bunch of national groups that will educate you and help you see some initial deal flow. And so you can also start there.
Got it. That's great information. It's funny because it's probably right in front of your eyes and you just don't even know it.
Yeah, right. I mean, Google's an amazing place to start.
Well, is there one thing that you think that people should take away from this conversation about angel investing and just private investing in general?
Yeah, we vote with our dollars. And by engaging in the innovation economy, you are influencing what products show up in your day-to-day, whether it be software or something on the grocery shelf. And we all have a lot of power, both in the capital we can deploy, the social capital of saying you're behind someone and an idea, and using your network. And so don't count yourself out just because you haven't done it before, as long as you have the capital. And I should say also a way to get started angel investing is to look at venture capital funds, because it does help you dip your toe in and ensures diversification. So there's lots of ways to get started. And if you have the extra capital, it's a really exciting way to partake and make those votes in the things you care about.
Sure. That touches on another thing that we always talk about, is just focusing on what you can control. Right? Mm-hmm. If you look at the global economy, it's overwhelming and it's so outside of your control. Yet, if you drill down to the very specific company, concept, founder, that is someone you can actually literally touch and help move the needle.
Yep. Even if you're just boosting their posts on social media and commenting and resharing, like these things matter and it helps get the word out.
Yeah, that's awesome. So where can people, if they want to find you, where can they do so?
On LinkedIn or TikTok. And my handles are all Jessica L. Lynch. And you can shoot me a DM, and happy to answer questions or pull you into the fold.
That sounds great. And we'll include those in the show notes as well. So you can find that on the Beyond Your Hammock site, as you usually do with our podcast. If you want to get in contact with Jess. I mean, Jess, this has been awesome. I know we go way back and we're friends, and this was just really cool to be like business conversation focused and learn about truly what you do and how accessible it can be for almost everybody.
Yeah. Agreed.
So thanks for being here.
Thanks for having me.
Thanks for listening to another episode of Money for Life, hosted by Eric Roberge, CFP and founder of Beyond Your Hammock, and me, Kaylee Roberge. Our show is produced and edited by Steve Stewart. If you want to learn more about wealth management and hiring your own personal financial advisor, visit beyondyourhammock.com. And now for the legal stuff. This podcast is for informational purposes only and does not constitute financial, legal, or tax advice, and may not cover all critical, complete details of every situation discussed. The views expressed by guests are their own and do not necessarily reflect those of the host or the podcast. Please consult a qualified professional about your specific situation before making any financial decisions based on this podcast or any other educational content designed for a general audience.